Welcome back to Investing Talk Podcast.
Today we're looking at Moderna.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out. Now, let's set the stage properly. It is January 2026. For the last, 3 years, the narrative around this company has been just absolutely brutal.
Oh, yeah.
If you were reading headlines in 23, 24, the street treated them like a total one-trick pony. The thinking was simple. They got lucky with the pandemic, lightning struck, and once the virus faded, they'd fade right along with it. But looking at the numbers in the pipeline today, that narrative isn't just shifting, it's being dismantled. We are looking at a massive pivot from, let's call it pandemic defense to oncology offense.
That is the perfect way to frame it. We're finally seeing that platform thesis actually play out.
Right.
You remember for years the bulls were all shouting that mRNA wasn't just for vaccines, it was for everything, the software of life, you know?
It's just a story, a marketing line.
Exactly. But now, in 2026, it's not just about boosters anymore. It's about a tech platform that's yielding real, tangible data in cancer treatment. The question has moved from, is COVID over, to can you actually cure melanoma? And the data suggests they might be on the verge of something historic.
Okay, the fundamentals are stabilizing, but let's get right into the numbers. How healthy is the business in 2026?
Well, if you just strip away the stock price and look at the ledger, it's surprisingly robust. They just reported full-year revenue for 2025 coming in at $1.9 billion.
Whoa, I have to stop you there. $1.9 billion. Compare that to the pandemic peak. Weren't they pulling in like 18 or 19 billion?
They were.
That is a massive come down. To the casual observer, that looks like a company that's shrunk by 90%. How is that robust?
It is a fraction, no doubt, but you have to look at expectations versus reality. The market had priced them for absolute disaster. That $1.9 billion actually beat their prior guidance by about $100 million. They over-delivered in a year where everyone expected them to miss. And it wasn't an accident. It was driven by much improved commercial execution and an expanded portfolio. We're not just talking about Spikevax, the COVID shot anymore. We're seeing contributions from mNEXSpike and mRESVIA.
Okay, for anyone who hasn't tracked the tickers, break those down. mRESVIA is the RSV vaccine, correct?
Correct, mRESVIA for RSV. And mNEXSpike is their next-gen COVID formulation. The key takeaway here isn't the raw dollar amount, but the fact that they're diversifying. It proves they can sell more than one product.
Okay, so they beat low expectations. That feels less bad than good. What does 2026 look like? Are we seeing actual growth or just a slower bleed?
We are seeing actual quantifiable growth. The company is anticipating nearly 10% revenue growth in 2026.
10%.
Yeah, and that's the signal investors were waiting for. It marks the inflection point where the line on the chart stops going down and starts, curling up.
So where's that growth coming from? Is it just selling more shots?
A few places. First, you've got that repeatable booster market for high-risk groups. That sets a steady baseline, but the real kickers are the government partnerships. They've locked in long-term deals with the UK, Canada, Australia. In fact, there's a specific cash injection, a $200 million payment from the UK that's expected in Q1 2026.
That's a nice lump sum to start the year, but it just feels like it's keeping the lights on.
It does more than that. It stabilizes the ship. It validates that governments still see mRNA as critical infrastructure for national security. They're basically paying to keep the factory running so it's there if they need it again.
Right. I'm going to put my skeptic hat on properly now. We talk about revenue, and 10% is fine. But we have to look at the financial health, the cash position. Pivoting a company like this from infectious disease to oncology is incredibly expensive.
It's a cash incinerator usually.
Exactly. So the balance sheet. They ended 2025 with $8.1 billion in cash and investments. Total liquidity is around $9 billion. That sounds like a war chest.
It definitely is. In this interest rate environment, having $9 billion liquid is a huge advantage.
But, and this is the big but, the burn rate. Their operating expenses are projected at $4.9 billion for 2026. Sarah, they're burning through half their war chest in a single year. Potentially.
Well, you have to spend money to make money, right?
But do the math. You have $9 billion, you're burning almost $5 billion a year.
Yeah.
You have less than 2 years before things get tight. And management is targeting cash break even by 2028.
Yeah, that's still 2 years out.
It's 2 years of sweating out the bank account.
That's a fair concern. And honestly, it is the primary bear case. But look at what that spending is for. They're funding a massive pivot. And importantly, they don't have a significant debt load.
Right.
That allows them to reinvest aggressively in oncology rather than, doing buybacks just to keep investors happy. They are betting the farm on the science.
So they're choosing innovation over financial engineering. Respectable, but risky.
It is, but that brings us to the moat. Why is this a calculated risk? Because that whole mRNA platform argument is stronger than ever.
Let's break that down. Platform is such a buzzword. What does it actually mean here?
Think of it like software versus hardware. Traditional vaccines, they're like hardware. If you want to change them, you have to build a whole new factory, start a complex biological process from scratch. It takes years.
Right.
mRNA is like software. You just change the code, the genetic sequence, and the manufacturing process is largely the same. Their advantage is speed to market.
And that speed eventually translates to money. But you need partners to validate it.
And that's where their relationship with Merck comes in. This is the linchpin of the bull case.
The collaboration on Keytruda.
Yes, Keytruda is one of the best-selling drugs in the world. They're combining Moderna's personalized cancer vaccine with Merck's blockbuster drug. That partnership creates incredibly high switching costs.
Explain switching costs for an investor. Why does that matter?
Well, once a patient is on a combination therapy that's trained to their specific tumor, you can't just swap in a competitor. The therapy is bespoke. And for Merck, it extends the life of their Keytruda franchise. It just validates the tech.
Okay, the fundamentals are stabilizing, but let's look at the chart. What is the price action telling us?
It's telling us that the psychology has completely shifted.
The stock surged 12% on those 2025 projections, right? Then after the JPM Healthcare Conference, it jumped another 15%.
That's a massive move for a company this size. You usually see that in small-cap biotechs.
It hit a 52-week high as 46.29. For a stock that was so beaten down, that feels significant.
It feels like a breakout. We're seeing the stock finally breaking out of that long post-pandemic slump, the narrative down 90%. Now we're seeing higher highs and higher lows. That signals a change in trend. People are buying the dips now, not just selling the rips.
And the volume backs that up. We saw volume spike to over 4 million shares on the highs.
Why does that volume matter to you?
Because price without volume is a lie. Low volume, it could just be retail traders messing around.
Yeah.
But 4 million shares, that tells me institutions are getting involved. Big money is stepping back in.
Exactly. And the options activity is elevated. It suggests bullish flow, but it also means we should expect some serious volatility.
Speaking of which, I have to point out a flashing red light on the dashboard. The technicals aren't all rosy.
What are you seeing?
The RSI, the Relative Strength Index.
Walk us through that for anyone who doesn't stare at charts all day.
Sure. It's basically a heat check. It measures if a stock has gone too far, too fast, on a scale of 0 to 100. Right now, Moderna's RSI is at 74.26.
That's hot.
It is very hot. Anything over 70 signals overbought territory. So while the trend is up and the momentum is bullish, statistically, a short-term pullback is pretty likely.
That's a good point. It might need to cool off, maybe retest that $40 level before the next leg up.
So the charts are heating up, but what is the broader market feeling? Let's look at the sentiment.
If you look at the quantitative data, it's incredibly positive. The Alpha Vantage data shows a weighted sentiment of roughly 0.45.
Translate that for us.
That falls into the strongly bullish category. It's a score from scraping news headlines and analyst reports. A year ago, this score would have been negative. The conversation has fundamentally changed.
That's a huge shift.
And when you dig into the news flow, 5 out of 7 high-relevance items are bullish. The news cycle has turned.
But why? What's driving this? It's not the boosters. Nobody is writing glowing articles about flu shots.
No, the excitement isn't about COVID, let me be clear. It's about cancer.
It's the pivot.
It's the pivot working, specifically the data that dropped. They released phase 2b melanoma data, showing a 49% risk reduction when they combine their therapy with Keytruda.
49%. Let's pause on that number. Because in the medical world, how big is that really?
It's staggering.
In oncology, you usually celebrate, what, a 15 or 20% improvement?
Exactly. 20% is a blockbuster. 49% is nearly cutting the risk of recurrence or death in half. That's a game changer. That's why investors are starting to see them as an oncology innovator.
Okay, but here's where it gets really fascinating. We have this contradiction. Sentiment is high, stock is ripping, data is good, but the consensus analyst rating is still reduce.
It's bizarre, isn't it?
And their average price target is around $30.36.
Which is way below where it's trading now.
Exactly. The stock is over $46, but the analysts think it's worth $30. Why are they dragging their feet?
It just highlights the difference in how they model things. Analysts live in spreadsheets. They're looking at the current decline in vaccine revenue, that cash burn we discussed. Their models look ugly for the next 24 months.
So they're looking at the math of today.
Right. But the market is a dreaming machine. The market is betting on 2028. It's pricing in that cancer pipeline that isn't on the revenue sheet yet.
So analysts are looking in the rearview mirror, and investors are looking through the windshield.
That's a great way to put it. And if you look at the catalyst calendar, there's plenty to justify looking forward.
What should we be watching for in the next quarter?
First, the Q4 earnings confirmation, late Jan or early Feb. Then, in early 2026, we're expecting the 5-year phase 2 data for Intizmarin.
That's the cancer vaccine. Why is 5 years so important?
5-year data is the gold standard in oncology. If you're cancer-free for 5 years, you're generally considered cured. It proves durability. And finally, keep an eye on regulatory updates for the flu vaccine approval. That's the cash flow bridge.
Okay, the future looks bright, but I'm not letting them off the hook.
We have to cover the risks because there are still holes in the boat.
There are always risks in biotech.
First, revenue volatility. COVID and RSV demand is falling. The pandemic cash cow is drying up. If that booster market collapses faster than expected, that 10% growth projection vanishes.
That's the reality. They're walking a tightrope between fading vaccine revenue and future oncology revenue.
And then there's the H5N1 risk.
The bird flu. Right. They lost the U.S. contract for it. Even if there's international funding, losing the U.S. contract is a blow. It shows that government contracts aren't guaranteed forever.
That's true. It adds a layer of uncertainty. You can't just assume Uncle Sam will always write the check.
And then there's just plain execution risk. The entire growth thesis relies on perfect execution of the oncology pipeline.
And in clinical trials, perfect execution is rare.
It's practically non-existent. If phase 3 melanoma data sees delays, or if that 49% number drops, or if the flu vaccine hits a snag, the stock has a long way to fall back to that $30 target.
That's the danger of trading on potential. If the potential gets delayed, the premium just evaporates.
But you have a counterpoint on the macro side, right?
I do. The macro environment is actually helping them. The biotech sector is seeing a rotation. Investors are moving capital into undervalued innovators. And we're seeing an M&A surge, $64 billion in deals in 2025 alone.
So big pharma is shopping.
Big pharma is hungry, they face patent cliffs, and they need to buy new drugs. When you have a company like Moderna with a validated platform and a $9 billion war chest, it creates a floor. That macro wind helps protect the downside.
It's a fair point. A rising tide lifts all boats, especially ones with $8 billion in cash.
So weighing the $8 billion war chest against the declining vaccine sales, what is the verdict?
I've looked at this from every angle, and my final verdict is a bullish score of 8 out of 10.
8 out of 10, that's confident.
It is. Here's the thesis. The company has successfully built a bridge to 2028. That's the key. With $9 billion in liquidity, they can afford to wait.
Time is on their side.
It is. And that 49% risk reduction data in melanoma, I just can't stress enough what a game changer that is. It validates the platform beyond infectious diseases, and the fact they're projecting 10% growth for 2026 signals the bottom is in.
I have to say, I'm still skeptical of that overbought RSI. Buying right here at the highs feels dangerous, and those reduced analyst ratings make me nervous.
But the street is often late to the party.
That is true. And I admit, the cash position and that breakout momentum are hard to bet against. I can see the multi-year hold potential. If they pull off the cancer vaccine, $46 is going to look incredibly cheap.
Incredibly cheap.
But for the short term, I'd be careful chasing it right at these highs. Let it cool off a bit.
That's prudent, but the direction of travel seems clear.
Well, there you have it. A pivot from pandemic defense to oncology offense. That's it from Moderna. If you enjoyed this analysis, make sure to subscribe to the channel so you don't miss the next one. We'll see you next time.